Welcome to episode 6 of the MLO Exam Prep Podcast. In this episode, we'll explore loan products and key lending terms, an essential area of knowledge for both the exam and your career as an MLO. We'll cover conventional versus government loans, fixed rate versus adjustable rate mortgages, loan product eligibility and guidelines, specialized loan programs. Let's get started. Conventional loans versus government loans. Conventional loans. A conventional loan is a mortgage that is not insured or guaranteed by the federal government. These loans are funded by private lenders, such as banks, credit unions, and mortgage companies. Key features of conventional loans typically require higher credit scores, often star 620 or higher. Borrowers must meet debt-to-income DTI ratio requirements, usually 43% or lower for most lenders. Private mortgage insurance, PMI, is required if the borrower puts less than 20% down. Loan amounts are subject to conforming loan limits, which are set by the Federal Housing Finance Agency each year. Exam tip. A test question might ask, which of the following is a characteristic of a conventional loan? The correct answer is, it is not insured or guaranteed by the federal government. Government-backed loans. Government loans are insured or guaranteed by federal agencies, making them more accessible to borrowers who don't meet conventional loan criteria. FHA loans, Federal Housing Administration, designed for low to moderate income borrowers, requires a minimum down payment of 3.5% with a credit score of 580 or higher. Borrowers with a credit score between 500 and 579 must put down at least 10%. Mortgage insurance premium, is required for the life of the loan unless the borrower puts down at least 10%. Loan limits vary by location and are set by HUD. Exam tip. If asked, what is a primary advantage of an FHA loan? The answer is, it allows borrowers to qualify with a lower credit score and a smaller down payment. VA loans, Department of Veterans Affairs, only available to eligible military service members, veterans, and qualifying spouses. Requires no down payment, no private mortgage insurance PMI required. A VA funding fee applies, which varies based on loan type and borrower status, but is waived for certain disabled veterans. Exam tip. A test question may ask, what is a key benefit of a VA loan? The correct answer is no down payment is required. USDA loans, United States Department of Agriculture Rural Housing Loans, designed for borrowers in eligible rural areas, requires no down payment. Borrowers must meet income eligibility limits, which vary by location. Instead of PMI, borrowers pay an annual guarantee fee. Exam tip. A question might ask, what type of loan is available for borrowers purchasing a home in an eligible rural area? The correct answer is USDA loan. Comparing conventional versus government loans. Loan comparison summary. Conventional loans require a down payment of at least 5%, but 20% is recommended to avoid PMI. They typically require a credit score of 620 or higher, and PMI is required if the borrower puts down less than 20%. These loans do not have special eligibility requirements. FHA loans allow for a 3.5% down payment with a credit score of at least 580. If a borrower has a credit score between 500 and 579, they must put down at least 10%. MEMIP is required for the life of the loan unless a borrower puts at least 10% down, in which case MEP cancels after 11 years. VA loans require no down payment and no PMI, but a funding fee is required unless waived for certain disabled veterans. This program is only available to eligible service members, veterans, and qualifying spouses. USDA loans also require no down payment, but are only available to borrowers in eligible rural areas and require income qualification. Instead of PMI, an annual guarantee fee is required. Exam tip. A question may ask, which loan type requires no down payment and is only available to military service members? The correct answer is VA loan. Closing thoughts on Part 1. Key takeaways. Conventional loans require higher credit scores and PMI if LTV exceeds 80%. FHA loans allow low down payments but require MIP for most borrowers. VA loans have no down payment and no PMI, but only eligible military borrowers qualify. USDA loans offer 100% financing for borrowers in eligible rural areas. In Part 2, we'll compare fixed-rate mortgages versus adjustable-rate mortgages ARMs, how ARMs adjust and how to calculate new rates, loan product selection considerations. Stay tuned. Welcome back to Episode 6 of the MLO Exam Prep Podcast. In Part 1, we compared conventional and government loans, breaking down eligibility, down payment requirements, mortgage insurance, and special qualifications. Now, in Part 2, we'll explore fixed-rate versus adjustable-rate mortgages, ARMs, how ARMs adjust and how to calculate new rates, loan product selection considerations. Let's dive in. Check fixed-rate mortgages, FRMs. Definition: a fixed-rate mortgage, FRM, is a loan with an interest rate that remains the same for the entire term of the loan. Key features: monthly principal and interest, P&I payments never change. Stable budgeting, since payment amounts remain the same. Common loan terms, 15, 20, or 30 years. Higher initial interest rates compared to ARMs. When to choose a fixed-rate mortgage. Best for borrowers who plan to stay in their home long-term. Ideal when interest rates are low and expected to rise. Preferred by risk-averse borrowers who want stability. Exam tip. A question may ask, what is a primary benefit of a fixed-rate mortgage? The correct answer is predictable monthly payments for the life of the loan. Adjustable-rate mortgages, ARMs. Definition: an adjustable-rate mortgage is a loan with an interest rate that changes periodically based on a market index. Key features: the initial interest rate is fixed for a set period, then adjusts. Rate adjustments are based on a financial index and a margin. Monthly payments may increase or decrease after adjustments. Includes rate caps to limit interest rate changes. ARM structure explained. ARM loans are typically named using two numbers. For example, a 5-1 ARM or a 7-1 ARM. The first number represents the number of years the initial fixed rate remains in effect. The second number represents how often the interest rate adjusts after the initial period. Example: a 5-1 ARM has a fixed rate for 5 years, then adjusts once per year after that. A 7-1 ARM has a fixed rate for 7 years, then adjusts annually. Common ARM products: 3-1 ARM, fixed for 3 years, then adjusts annually. 5-1 ARM, fixed for 5 years, then adjusts annually. 7-1 ARM, fixed for 7 years, then adjusts annually. 10-1 ARM, fixed for 10 years, then adjusts annually. When to choose an ARM. Best for borrowers who plan to sell or refinance before the fixed rate period ends. Ideal when interest rates are high and expected to drop. A good option for borrowers comfortable with possible rate increases. Exam tip. A test question may ask, what does the 5 in a 5-1 ARM indicate? The correct answer is the initial fixed rate period lasts for 5 years. How ARM rates are calculated. Two components of an ARM interest rate. 1. Index, a benchmark interest rate that fluctuates based on market conditions. 2. Margin, a fixed percentage set by the lender, added to the index to determine the new rate. Formula for adjusted rate. Index, margin, equals new interest rate. Example: a borrower has a 5-1 ARM with a margin of 2.75%, an index rate of 3.25% at the time of adjustment. Using the formula, 3.25% index plus 2.75% margin equals 6.00% new interest rate. Common ARM indices: SOFR, Secured Overnight Financing Rate; COFI, Cost of Funds Index; CMT, Constant Maturity Treasury; COSI, Cost of Savings Index. Exam tip: a test question may ask, which component of an ARM rate is set by the lender and does not change? The correct answer is the margin. ARM rate caps and adjustments. To protect borrowers from extreme rate increases, ARMs include rate caps that limit how much the interest rate can change. Types of rate caps. 1. Initial rate cap. Limits the rate increase or decrease at the first adjustment. 2. Periodic rate cap, limits how much the rate can change per adjustment. 3. Lifetime rate cap, limits the total increase over the life of the loan. Rate cap example. A 5/1 ARM has a start rate of 4.00%, an initial rate cap of 2%, a periodic cap of 2%, a lifetime cap of 6 cents. If the index increases enough for a higher adjustment, the new rate in year 6 would be 4.0% start rate plus 2.0% initial cap, 6% new rate in year 6. If the index continues rising, 6.0% new rate plus 2.0% periodic cap equals 8.2% new rate in year 7%. Final maximum rate, 4.0%, start rates plus a percent, 0.0%. Exam tip. A question might ask, what does the lifetime rate cap do? The correct answer is, it limits the total interest rate increase over the life of the loan. Fixed rate versus ARM loan comparison. Fixed rate mortgage summary. Best for long-term stability. Monthly payments never change. Higher initial interest rates. Adjustable rate mortgage summary. Lower initial interest rates. Rates adjust periodically based on index plus margin. Rate caps limit increases. Exam tip. If a borrower plans to stay in a home long-term, a fixed-rate loan is the best choice. If they plan to sell or refinance before adjustments begin, an ARM could save money. Key takeaways. Fixed-rate mortgages provide stability with unchanging payments. Adjustable rate mortgages start with lower rates but adjust periodically. ARM rates are determined by an index plus margin. Rate caps prevent extreme increases in interest rates. In Part 3, we'll cover specialized loan products, non-conventional loan programs, non-QM and portfolio loans. Stay tuned. Welcome back to Episode 6 of the MLO Exam Prep Podcast. In Parts 1 and 2, we explored conventional versus government loans, fixed rate versus adjustable rate mortgages, ARMs, ARM rate adjustments, calculations, and caps. Now in Part 3, we'll cover specialized loan products, including non-conforming and jumbo loans, non-QM loans, portfolio loans, interest-only and balloon mortgages. Let's dive in. Non-conforming and jumbo loans. What are non-conforming loans? A non-conforming loan is a mortgage that does not meet the guidelines set by Fannie Mae and Freddie Mac. Common reasons a loan is non-conforming. The loan amount is too high, exceeds conforming loan limits, the borrower has a unique credit or income profile, the property does not meet standard underwriting requirements. Jumbo loans. A jumbo loan is a non-conforming loan that exceeds the loan limits set by the FHFA, Federal Housing Finance Agency. Key features of jumbo loans: higher loan amounts than conventional conforming loans, stricter credit requirements, often require 700-plus credit scores, larger down payments required, often 10 to 20%, higher interest rates due to increased lender risk. Exam tip. A test question may ask, what makes a loan a jumbo loan? The correct answer is a loan amount that exceeds conforming loan limits. Non-qualified mortgage, non-QM loans. What is a non-QM loan? A non-QM loan is a mortgage that does not meet the criteria of a qualified mortgage, QM, under the ability to repay ATR rule. Common borrowers for non-QM loans: self-employed borrowers who cannot document income traditionally, real estate investors using rental income instead of W-2 income, borrowers with high debt-to-income, DTI, ratios above 43%, foreign nationals, or those with limited credit history. Key features of non-QM loans: may allow alternative income verification, such as bank statements, may have interest-only or balloon payment structures, higher interest rates due to increased lender risk, not backed by government agencies like FHA, VA, or USDA. Exam tip. A test question may ask, which borrower would most likely use a non-QM loan? The correct answer is a self-employed borrower with fluctuating income. Portfolio loans. What is a portfolio loan? A portfolio loan is a mortgage that a lender keeps in its own portfolio instead of selling on the secondary market. Key features of portfolio loans: more flexible underwriting guidelines, used for borrowers who don't meet traditional lending criteria, often require higher interest rates to offset lender risk, not subject to Fannie Mae or Freddie Mac guidelines. Exam tip. If a test question asks, what makes a portfolio loan different from other mortgage products? The correct answer is, it is retained by the lender rather than sold on the secondary market. Interest-only and balloon mortgages. Interest-only mortgages. An interest-only mortgage allows a borrower to pay only the interest for a set period, typically 5 to 10 years, after which the loan switches to fully amortizing payments. Pros and cons of interest-only loans. Lower initial payments during the interest-only period. More cash flow flexibility for borrowers with fluctuating income. Higher total cost over the life of the loan. Payments increase significantly when principal payments begin. Exam tip. A question may ask, what happens after the interest-only period ends? The correct answer is, the loan converts to a fully amortizing payment schedule. Balloon mortgages. A balloon mortgage has low monthly payments for a set period, but requires a large lump sum balloon payment at the end of the loan term. Common balloon mortgage terms. 525 or 723 loans. The first number represents the initial fixed period, and the second number represents the due date for the balloon payment, typically used for short-term financing needs. Key risks of balloon loans. Borrowers must refinance or pay off the balance at the end of the term. High risk if the borrower cannot secure new financing. Exam tip. A test question may ask, what is a major risk of a balloon mortgage? The correct answer is, the borrower must make a large lump sum payment at the end of the loan term. Closing thoughts on Part 3. Key takeaways. Non-conforming loans do not meet Fannie Mae and Freddie Mac standards. Jumbo loans exceed conforming loan limits and require stricter qualifications. Non-QM loans serve self-employed borrowers and others with alternative income documentation. Portfolio loans are kept by the lender instead of being sold on the secondary market. Interest-only mortgages have lower initial payments, but increase after the interest-only period ends. Balloon mortgages require a large lump sum payment at the end of the loan term. In Part 4, we'll conclude Episode 6 by covering reverse mortgages, home equity loans and HELOCs, construction loans and bridge loans. Final exam-style quiz. Stay tuned. Intro, welcome back to Episode 6 of the MLO Exam Prep Podcast. In Part 3, we covered specialized loan products, including jumbo and non-conforming loans, non-QM and portfolio loans, interest-only and balloon mortgages. Now in Part 4, we'll explore reverse mortgages, home equity loans and HELOCs, construction and bridge loans. Let's get started. Reverse mortgages. Definition: a reverse mortgage is a loan that allows homeowners aged 62 or older to convert home equity into cash without making monthly mortgage payments. Key features of reverse mortgages. The borrower must occupy the home as their primary residence. No monthly payments. The loan is repaid when the borrower sells, moves, or passes away. The loan amount is based on the home's value, borrower's age, and interest rates. The FHA-insured reverse mortgage program is called a home equity conversion mortgage, HECM. Reverse mortgage eligibility. Borrower must be at least 62 years old, must own the home outright or have a low remaining mortgage balance. Home must meet FHA property standards. Exam tip. A test question may ask, what is the minimum age requirement for a reverse mortgage? The correct answer is 62 years old. Home equity loans and HELOCs. Home equity loan second mortgage. A home equity loan is a lump sum loan that allows homeowners to borrow against their home's equity. Key features of home equity loans: fixed interest rates, fixed monthly payments, loan amount based on home equity and creditworthiness. Home equity line of credit. A HELOC is a revolving line of credit secured by the borrower's home. Key features of HELOCs: variable interest rates, a draw period, typically 10 years, where borrowers can withdraw funds, a repayment period, typically 10 to 20 years, where funds must be repaid. Key differences: Home equity loan versus HELOC. Home equity loan. Borrower receives a lump sum and repays in fixed installments. HELOC. Borrower accesses funds as needed, similar to a credit card, and repays as they go. Exam tip: a question may ask, which loan type allows a homeowner to access funds as needed? The correct answer is HELOC. Construction loans and bridge loans. Construction loans. A construction loan is a short-term loan used to finance the building of a new home. Key features of construction loans: short-term, typically 12 months or less, higher interest rates than standard mortgages. Funds are released in stages, draws, as construction progresses. The borrower typically refinances into a permanent mortgage once construction is complete. Two types of construction loans. Construction to permanent loan converts into a permanent mortgage once the home is built. Standalone construction loan. The borrower must apply for a separate mortgage after construction is finished. Exam tip: a question may ask, what happens at the end of a construction to permanent loan? The correct answer is, the loan converts into a permanent mortgage. A bridge loan is a short-term loan that helps borrowers finance a new home purchase before selling their existing home. Key features of bridge loans: used when a homeowner buys a new home before selling their current home, allows homeowners to use their existing home's equity for the new home's down payment. Typically lasts 6 to 12 months. Exam tip: a question may ask, which loan is designed to help homeowners purchase a new home before selling their existing home? The correct answer is bridge loan. Final exam-style quiz questions. What is the minimum age required to qualify for a reverse mortgage? A, 55 years old, B, 60 years old, C, 62 years old, D, 65 years old. Correct answers: reverse mortgages are only available to borrowers age 62 or older. Which of the following is true about HELOCs? A, HELOCs have fixed interest rates. B, HELOCs provide a lump sum to the borrower. C, HELOCs have a draw period where the borrower can access funds as needed. D, HELOCs require a borrower to be at least 62 years old. Correct answer: C, a HELOC functions as a revolving line of credit, allowing borrowers to access funds during a draw period. 3. How does a construction to permanent loan work? A, the borrower makes interest-only payments during construction, then refinances into a new mortgage. B, the loan automatically converts into a permanent mortgage after construction is complete. C, the borrower must sell their home before applying for a construction loan. D, the borrower must apply for a separate mortgage once construction is completed. Correct answer: B. A construction to permanent loan automatically converts into a permanent mortgage once construction is finished. 4. What is the main purpose of a bridge loan? A, to finance home renovations. B, to allow homeowners to purchase a new home before selling their current home. C, to refinance a high-interest mortgage. D, to help borrowers consolidate debt. Correct answer: bridge loans help homeowners buy a new home before selling their current home. Closing thoughts on 4. Key takeaways. Reverse mortgages allow homeowners 62 plus to convert home equity into cash with no monthly payments. HELOCs provide a revolving credit line, while home equity loans offer a lump sum. Construction loans finance new home construction and are either standalone or construction to permanent. Bridge loans help borrowers purchase a new home before selling their existing home. This concludes Episode 6, Loan Products and Lending Terms. In Episode 7, we'll cover mortgage loan origination process, application and documentation requirements, underwriting and loan approval, closing and post-closing procedures. Thanks for studying with us. You've got this.